Ladies and gentlemen, good morning and welcome to our Analyst conference today. We will speak about our results 2017, and then also we will speak about our new strategy 2022, Building for Growth. I have with me today Geraldine Picot, our CFO since beginning of the year. She will later talk about the results 2017. I also brought our new head of the region Europe, Marcel Cobus, with me. And Oliver Oswald, our head of the most successful region, Latin America. Morning. They will both be available for your questions and comments later, and we have some time after the formal presentations. Great. I like to take just a few minutes to give you an overview on the highlights and the key developments for 2017 and how we develop the business further. And then we go into more details with Geraldine. We had an excellent year 2017. We achieved a sales growth of almost 5%. Our EBITDA growth over proportional, over 6%. I'm very happy with this. It's a great foundation now to go forward and launch our new growth strategy. If you look in the individual results, you will notice that we have 4 out of the 5 regions with significant contributions to this growth. We have 2 regions, North America and Latin America, with double-digit EBITDA growth. We have Europe with a good EBITDA growth, and we expect much more to come from Europe for this 2018 and the years to come. And we also have Middle East Africa with some growth in EBITDA. Asia Pacific is the only region which didn't contribute to the growth. However, here we have a different picture. We have a huge growth in India, while we had a challenging situation in Southeast Asia. So I'm very happy with the results. I think it's a great foundation now to launch the growth strategy, where we want to not only grow our profit through efficiencies, but actually from real above market growth going forward. We have reassessed our asset base. Geraldine will talk about this. I think I'm happy she did a good assessment of the situation and came up with impairment, which is a significant size, but ensures us that we don't have this discussion going forward, and we have a clean and lean enough balance sheet going forward. So I'm happy we have this as a start for the new strategy. I think it's fair to say we have the merger completed. The biggest positive outcome for me is that we have very strong country positions. By merging the 2 companies, we have really leading positions in the US, in Canada, in quite a few Latin America markets, Southeast Asia, India, we are number 2. In Europe, we made very good merging here, the 2 asset space, and this is, honestly speaking, I'm very happy and very positive looking into the future with this. We talk about the strategy in a moment, about how we're going to generate growth, both on top line and bottom line. And maybe just to conclude the intro, we are very positive for 2018. We're going to have a good market environment, and we are confirmed to further growth of our business 3 to 5%, and an over-proportional operating profit of at least 5%. I think with this, I'd like to hand over to Geraldine. She will give you more details on the results, and I come back then with the strategy.
Thank you, Jan. Good morning, everyone. It's now been 8 weeks. I'm in the role and in the company. I'm very proud to have joined that company. Great colleagues, a great team I want to thank, and a great future. Okay, I'm going to take you through our annual earnings presentation, starting with the 2017 performance highlights. And as you can see, a very strong operational performance, fully in line with the guidance that Jan expressed last October. and that translates here into strong metrics. Our net sales amount to 26.1 billion Swiss francs, up 4.7% on a like-for-like basis, driven by volumes and price. 2 years after the merger, we measure our profitability through the recurring EBITDA, which was formerly known as the operating EBITDA adjusted, which excludes restructuring, litigation, implementation costs, and systems linked to the merger and non-recurring items. Our recurring EBITDA is up 6.1% on a like-for-like basis, and our recurring EBITDA amounts to 6 billion for 2017. Our earnings per shares, that for the sake of clarity we present here before impairment and divestment, is up 11.9% at 2.35 Swiss francs per share. Free cash flow stood at 1.7 billion for 2017. If I now move on to the sales, you can see here that overall our sales are down 2.9%, and this is under the effect of the divestments of 2016 and 2017 that produces a negative scope effect, a scope out effect of 6.5%. We have also a negative effect coming from the Forex for 1.1%. But most important is a like-for-like growth, constant scope, constant rate of 4.7%, that has been driven by cement volumes and pricing dynamics. If I now turn on to the EBITDA, the recurring EBITDA, and for the record, operating EBITDA adjusted has been renamed recurring EBITDA. It is basically the operating profit before depreciation and amortization and before non-recurring items. It does include the sales, the operational cost in the normal course of business, and also the group share of net income of our joint ventures. And into this category, you can see our joint venture Washin, that is a scope-in effect for 126 million Swiss francs. You have also the scope-out effect of the disposal for 323 million Swiss francs and a negative Forex impact of 106 million Swiss francs. Now, focusing on the like-for-like growth of our recurring EBITDA, that amounts to 343 million Swiss francs, you can see that it benefited from both a volume contribution of 65 million and also a price over cost, or ability to overperform, to be over the cost inflation and the energy, and to generate 278 million Swiss francs. If you look at the world map of where our sales and recurring EBITDA stems from, you can see here that basically all regions contributed over 1 billion to the 6 billion of EBITDA, recurring EBITDA of the group, from all the regions. If I go into the regions per se now, and start with Europe, you can see here that Europe posted an increase in net sales, volumes, and actually also recurring EBITDA. You can see even that the recurring EBITDA here is growing higher proportionally than the sales. So that's, I think, an important fact to note. And where does it come from? It comes from the strong contribution of Eastern Europe, Russia, Poland, also Romania. In France, it's worth to note that there has been an improvement on the market condition, starting on the second half, accelerating in the Q4 with an upturn in the housing, and that helped also associated to the revision that we've done of our industrial footprint, that helped also to boost our profits in France with higher utilization of our plants. Switzerland has been a bit difficult. We had a more challenging market with the end of large infrastructure projects. In the UK, I want really to highlight the performance of our UK operations, because we have a strong exposure there to our downstream segments, such as asphalt and constructions, that is basically helping us to deliver both a robust performance and also to build a resilient business. If I now turn on to Middle East Africa, it's important to note that Middle East Africa is a region that brought to the group more than 1 billion of recurring EBITDA. Strong contribution, actually, of Algeria in the 2017 recurring EBITDA of the region. And this, despite a more challenging environment due to a weaker cement demand in Algeria, notably in Q4, where we turned into an oversupply situation in the market. But we reinforced our commercial differentiation, and we also adapt our cost base in Algeria. In Nigeria, we recorded a strong performance for the year. We doubled our recurring EBITDA in Nigeria. And we also continued actively our cost measures by adapting our plants to use alternative fuel usage, also optimizing the logistics setup. In Egypt, there was a lot of cost pressure on our margins, but we grown in terms of sales on the back of our export strategy. If I now turn on to Asia Pacific, it's a contrasted performance in Asia Pacific. As you can see, actually we have our sales growing by 6.7% on a like-for-like basis. We have a recurring EBITDA down 6.9%. But in India, we overperformed the market. We have strong volumes. We had good margins, and that was really supported by a lot of commercial initiatives, a lot of push on our premium products, all this in a favorable environment. In China, we also had a very solid performance, actually, and that was supported by the government initiatives on the environmental protection. And you know that all our plants in China are equipped with waste treatment, so it directly favored us. In Southeast Asia, the conditions were more challenging, and we had a lot of inflationary cost pressure in Southeast Asia. But it's to be noted that in Indonesia, we have the resumption of provincial and municipal projects. If I now turn on to North America, and 2017 in North America was again a very strong year. We delivered nearly 1.5 billion of recurring EBITDA. Look at the growth, double-digit growth on a like-for-like basis on our recurring EBITDA in North America. And that comes from both US and Canada. In the US, the volume trends really improved on the last quarter of the year. And our cement and aggregates operation benefited for an overall pricing effect throughout the year. We continued to work on cost, notably in terms of logistics. We have a flagship plant, St. Genevieve, that had a record production year in 2017. So in Canada, also strong volumes, strong activity, also improving at the year end in Canada West with a better situation into the oil sector in Canada West. If I move on to Latin America, so basically Latin America recorded a very strong year in 2017, a very solid performance actually in all quarters. You've seen in terms of sales, recurring EBITDA and cash. And the region contributed, as you can see, more than 1 billion Swiss francs to the recurring EBITDA of the group. Overall in the region, we really focused into accelerating our route-to-market initiatives, and one of them is exemplified by the rollout of the Disensa franchise. Mexico, to have some comments on the countries of the region, Mexico did a very good performance. We had an excellent year with growth in both sales and profit in Mexico, driven by a favorable commercial differentiations and also backed by some projects, infrastructure projects, such as the Mexico City new airport, for instance. Argentina had a recorded year ever with a double-digit growth, sales, and EBITDA. And finally, I would like to highlight Brazil, where we have ended our turnaround. Now the country is break-even. And even if the market is still challenging, I think our operations are doing well there. Now that I've gone through the EBITDA, the first line after the EBITDA is the impairment. And I would like to share with you that we have done our annual test of impairment of our goodwills, of our assets. So we have, with the team, taken into consideration all parameters, including, the country risk premium, and that has led us to recognize an impairment of 3.8 billion Swiss francs. This is non-cash. This is one time. And I believe this is a good redesign of our balance sheet to allocate future capital allocations to fuel our 2022 growth strategy. If I now move on to the P&L and the detailed P&L. So you can see here on the first line that our recurring EBITDA at real scope and rate has increased by 40 million Swiss francs. Our depreciation and amortization are broadly in line with 2016, and they are decreasing by 43 million Swiss francs. Our restructuring and others are also reducing by 121 million Swiss francs. This under the effect of a decreasing implementation cost, also under the effect of a reversal of a provision, and partially offset by some additional provision on restructuring and litigation. If I take into account the three impacts, I think it's worth noting that our operating profit, as you can see, is up 204 million Swiss francs, showing also the strengths of our operational performance. Now, if I comment the financial income and expenses, you can see that it has actually increased by 55 million Swiss francs. I'm talking, of course, before impairment and divestment. And this 55 are coming from actually a negative forex loss, plus actually some additional provisions on ongoing legal cases, offset by a lower cost of debt. This improvement in the cost of debt is about 15% improvement. If now I continue, you can see that our income tax rate is 30.5% before impairment and divestment, and it is up 1 point compared to last year. So that leads us to a reported net income of minus 1.7 billion to be compared to plus 2.1 last year. If we look at it before impairment and divestment, which we should do, then you can see it's flat compared to last year. It's basically that the impact below the operating profits that I just mentioned are actually offsetting the good operational performance of 204 million that I've just commented. Finally, if I go to the non-controlling interests, you can see that basically it's decreasing by 154 million Swiss francs, and that comes from the scope impact of the divested subsidiaries. It comes also from the fact that even if India has performed very well, it has been partially offset by the performance of our subsidiaries in Southeast Asia. So overall, at the bottom, you can see that we up 12% on an earning per share basis at 2.35 Swiss francs per share. If we compare our free cash flow generation to last year, you see that we are overall at the same level. And this is clearly also an area of focus for 2018. Basically, what we can see here is that the improvement on the recurring EBITDA plus the reduction on the CapEx spent and the reduction of the cost of debt are actually more or less offset by the increase in the working capital. And that is really an area of focus for the company for 2018. If I turn on to the net financial debt, well, first thing is that the debt is decreasing by 400 million, and that our leverage ratio is below 2.5, is at 2.4, in line with our objective. In the detail, what you can see is that our free cash flow, as you know, is 1.7 billion, that our disposals, the cash flow issued from the disposals amount to 1.3 billion, so in total 3 billion of cash generated that has been used to fund the dividend to our shareholders of 1.2 billion, and also that has been used to fund the share buyback program up to 500 million Swiss francs. You can see a negative forex impact here of around 378 million Swiss francs. That mainly comes from the appreciation of the euro against the Swiss francs, about 9% during 2017. And finally, if I now conclude and give you a little bit of an update on our dividend and our share buyback, our board will propose to the next AGM the distribution of 2 Swiss francs per share, in line with last year, as a dividend. And we have decided to actually discontinue our share buyback program in order to fuel our growth and our 2022 growth strategy. With this, I hand over to Jan, and thank you again for your attention.
Thank you. Thank you. Okay, I think with this we go into the strategy. Exciting new strategy, and I first will share some of the information on the markets with you, that we are actually in a growing market. Building materials is maybe the single biggest market in the world, and it's also a growing market, driven by 5 mega trends you see here. Easy to understand. We have population growth, another 2 billion of people in the next 30 years or so will need housing and so on. Then all these people will move into cities. We have the urbanization, which requires much more Lafarge-Holcim products than the countryside, from high-rise buildings to bridges to tunnels, all the infrastructure, to hospitals, to ports, to roads. So we have a huge mega trend going for us. Population growth, urbanization will lead to a market growth of 2 to 3% for us, and clearly ahead of GDP. So we're very excited with this, and it's also clear for us that we need to be with a growth strategy in such a market, and even have to use our stronger market position compared to competitors to grow our business above the market. When you look at cement, a bit more specific, this is the cement forecast. Also here, while the cement volume will not necessarily increase much in Switzerland, we have many, many markets in Asia, India, but also in North America, Latin America, and parts of Europe and Africa, where we have a significant growth in cement demand, and we are very positive here to participate in this. Our other business segments, ready-mix concrete and aggregates, will grow in about the same magnitude. So again, very positive markets. If you look a little bit about the overall overview, so building materials is a 2,500 billion market globally. If you take China out, like what we did here in the chart, it's over 1,700 billion in the rest of the world. And you see here our market position. Our traditional 4 segments are 3 of the largest segments in construction: cement, aggregates, and ready-mix concrete. And you see here the potential we still have. We have in cement, maybe our market share is 3%. Then in aggregates, it's 2%, and ready-mix concrete is around 3%. A big market, very fragmented market. So an ideal market to have a growth strategy, organic growth, investments, but also a lot of opportunities here for bolt-on acquisitions in these individual markets. When you look at our position here, again, I think the merger brought really a very strong asset base for us in the countries. We have leading market positions almost in all the markets we are active, and this is a great way to move forward. You look at our segments, and here I like to introduce our new segment. We're going to introduce Solutions and Products as our fourth business segments, another growth initiative. You will notice we already have over 2 billion Swiss franc in sales in products like precast, concrete elements, asphalt, but also mortars or insulation. We have these products are focused at the moment on very few specific countries, and this will be a great opportunity for us to roll this out into other markets. The profitability is already there, as you can see here, quite a good operating margin and also very low capital intense. This segment so has many benefits, closer to the customer, lower capital intensity, but huge growth potential. We have made our strategy simple. We have 4 value drivers, how we run the company from now on. The first one is growth, and we talk about the growth strategy in a moment. Simplification and performance, financial strength, and then vision and people. Let's talk about growth. So we have seen we have a growing market, and we are going to shifting our strategy now more towards growth. As you know, we have already seen a good growth in 2017 with almost 5%, and we want to continue at a similar pace. How are we going to do that? We will have many more agile strategies in the markets, especially in aggregates and concrete. We haven't been investing much in the past. Here we want to be more agile in the markets. You will see bolt-on acquisitions. You just saw one from us last week in the UK. We bought a very exciting aggregate business to complement our own operation. This was, I think, the first bolt-on acquisition in around 4 years we have done. So this is a starting point, and you will see now many more bolt-ons coming in the future to accelerate our growth and our margins in our markets. We will want to focus more investment, but on less markets. We have some very exciting growth plus markets, how we call them. So we have a great situation in the US, but also many markets in Latin America. We have great opportunities, Philippines, India, in selected African markets, but also in Europe, as just the acquisition in the UK has proven. So we're very excited to invest more into our business again, but into selective markets. You have seen our announcement last week in India. We're going to have a new cement factory coming up. India is our second biggest market, and the cement consumption will continue to grow over the next 20 years. So we're very excited to have here an organic investment to further grow the business. We have then for strategy a quick introduction, the fourth business segment. We have not really talked about this in the past. It's already there. More than 2 billion Swiss franc in sales, good profitability, good return on capital, and it's, as you can see here, we talk about mortars, we talk about concrete products, precast products, asphalt, and also we have quite a business in contracting and services. All these businesses are focused in a few numbers of markets at this point, and we are very happy going forward to make this an additional growth platform for LafargeHolcim. If we talk about simplification and performance, we have already started with this. The company is at the moment must be leaner. We want to be more corporate light, and we have to focus more on the countries. We have done already the first steps. We Now 35 of the countries are reporting directly to the group management compared to 20 before. We have already merged 2 of the business functions in the group management into one, all with the same goal to be more market focused and be less corporate heavy. This all will come out with a cost-saving program on SG&A, which will be in the magnitude of 400 million Swiss francs. We will complete this program already in Q1 next year, and this will be on corporate level, regional, but also in the countries where we believe we have too many duplications, too many resources, but also too heavy structures here going forward. On the performance side, we have a couple of challenges which we gladly take for the future. We have already aligned our KPIs, our incentive systems fully to the new strategy, and also we have empowered the countries fully. They are the profit and loss leaders, and this is how we want to run the business. In cement, we have a very efficient situation. We have actually very high returns. In aggregates and ready-mix concrete, we are actually lagging behind the competition, which you can easily see if you compare our numbers to some of the regional or also global competitors. And here we take the challenge to close the performance gap. Financial strength. I think important in our business, global business, this size, capital intense in cement, it's very important to have a very sound financial policy. And these are the 4 principles how we want to focus here on capital allocation and creating a financially even stronger company. On the return side, you have seen we are keeping the dividend at an attractive 2 Swiss francs. We also want to, in the future, grow the dividend together with the cash flow. We have on the balance sheet, we just made a big exercise with the impairment. I think this is a technical one and a very good one going forward for us. Investment rating for us is a must. We want to fully support all the requirements, what we need to fulfill. I think on the divestment side, I said we want to focus more investments, but on less countries. That also means we have maybe 2, 3, or 4 markets where there's a better owner, and it will not be us. So we have set a target of divestment in the magnitude of at least 2 billion. We want to complete that also in the course of this year and have signed divestments in the first quarter next year. On the investment side, you have seen 2017, we came out below 1.4 billion Swiss franc in investment. That's maybe a record low level. We will allow in the future for some more organic investments to grow the business. However, it will be kept with a strict ceiling, which we announced today of below 2 billion Swiss francs. Our business is a very local business, very decentralized. We are working in the countries with our factories, supply chains, mostly local customers, and the most important part of our business are the people. So our one of the 4 value drivers are vision and people, and here is clear we have to build the right culture for performance, for integrity, for trust, and for teamwork. Our targets we have set, we go forward with a profitable growth strategy. Our sales growth should be 3 to 5% year on year from now on. We want to grow the profitability over proportional. We commit to a minimum floor of 5% in EBITDA growth. One big area is the cash conversion is important, is too low at the moment at 28%. So we set the target to bring this up to over 40%. And then all this will come to a return on invested capital to over 8%, where we closed 2017 with 5.8%. So you see we have a sound strategy, clear drivers, and also clear target setting fully aligned here with all the country plans and also with management remuneration. The team, we hit the floor really running. We are in the middle of introducing the strategy. The organization is already in place. You see my team here. I made quite a few changes. We have 2 new regional managers for Europe with Marcel and René for North America. We have Geraldine on board beginning of the year as our new CFO. And also here we have digital and sustainability as direct reports for the first time. Of course, showing the big importance these 2 areas have for us going forward. We look into the implementation. Again, what we present today has been already in the making, so the organization is already in place. You see the last 3 months we made quite some changes, not only to the group management, but also we eliminated 1 layer of management, bringing the 35 countries directly to the group management. We have full accountability on profit and loss for the countries and also for the 4 business segments: cement, aggregates, concrete, and solutions and products. So really a different performance culture and accountability compared to the past. We have new plant in India already announced last week, same as the bolt-on acquisition. So you can expect from us that we have a little bit more speedy execution of the strategy also going forward into the future. The rest of 2018, we will complete our review of the asset portfolio. So we will maybe select a few markets for divestments, and also we will select our growth plus markets for the next rounds of investments. We will have dedicated growth plans for the countries and for the 4 business segments. And then our SG&A cost program will be fully planned and executed throughout the year with the closure of the offices at Singapore and in Miami already coming up the next couple of weeks. Then we are targeting that for 2019 we have our organization, the cost saving, the new margins already achieved in Q1, so the new company ready to hit new profit and loss levels in Q2 2019. With this, I come to the outlook. We are very positive for 2018 with the achievements 17 and very good markets. We are confirming that net sales growth will be 3 to 5% for the full year and over proportional operating profit, minimum at 5% for the EBITDA, and the capex will be below 2 billion Swiss francs. I think with this we can go to the Q&A session, if there are any questions. A few. And Geraldine and myself will be happy to answer any of them. Good.
Hello. Thank you very much for the presentation. Arnaud Lehmann, Bank of America, Merrill Lynch. I guess I'll just start with 2. First question is, you highlight the strengths of the industry and your vision about it. Could you please elaborate a little bit about the potential challenges? We know there are some emerging countries which are a little bit more difficult. There's more supply coming in places like Algeria or possibly Mexico. How do you see that? Is it cost inflation? Is it fragmentation? So the challenges of the industry is my first question. My second question is related to your acquisitions. You mentioned more bolt-on M&As. Would that be in existing markets? What's your objective? Do you want to consolidate some of these markets? Or do you want to expand in more products in existing markets? Thank you.
Good. I think for the M&A question, I think the bolt-on acquisitions, they are very profitable additions to the business if you do them right. They have to be rather in existing markets so that they can be bolt-on and you have synergies with your existing business in a certain market when it comes to customers, to channels, to operations, to supply chains. So the bolt-on ones we will target for existing markets and to create a value there. That's, I think, very important. We will, for the next question, we will fund these bolt-on acquisitions out of the cash flow, but also out of the divestment of assets going forward. Your first question, sir? The challenges for the market, yeah, that's a good question. And that's one of the most exciting aspects of building materials. What I personally like the best, it's a very decentralized market. So you have, as you mentioned, in every market, you have a different situation, a different life cycle. So you sell bagged cement or you don't sell bagged cement. And the sophistication of construction is different. The players are different. The supply situation is different. So you need to have a very agile local strategy. And this is what is a lot of fun to do. Then you have to see that you always have difficult markets and you always have very bullish markets. And this is a little bit the game, I think, in the future. We try to run a little bit better. I'm not the person who likes to talk much about the problem countries, because if I have 5 problem countries, I have 10 very bullish markets. And this is a bit building materials. We have to run much more country-based and more agile to make a great business.
Good morning, Nabil Ahmed from Barclays. Thanks for taking my questions. I got 2 actually, some of them related to Arno's question. First one on divestment. Could you share a little bit your thinking about it? I mean, is it going to be purely opportunistic? Are you looking to dispose some assets that are making less sense from a strategical standpoint? What sort of financial criteria as the management team is going to look at when assessing divestment opportunities? And second question, maybe on this new division, solution and products. Are you going to stick to the products you mentioned that are in there, or is there adjacent products or services that you think might fit well, and that's the key areas of expansion for the group in the future?
Oh, great. I think for the divestments, what we will do in the future, we will be very value focused. So we don't make the classical portfolio analysis and then we say we're selling the dog and we are raising the star. I think it has to be related to the value of the business. We are valuing every country, and if we are selling anything, it has to be above our internal value. So we are not in a hurry. We are in a good situation. And it will not be a massive sales off, but I think the 2 billion we want to achieve for Q1 next year. But value-based. We're not selling cheap. We are selling to generate and unlock some of the value we have in the assets. Huaxin is a great business. It's a great business. No plans to sell it. That's one of the jewels we have actually in our portfolio, with a great growth potential and a lot to learn from the way how they do the business and the process. Your second question, solutions and products. I'm really excited that we have already so many opportunities existing in the company. So we're talking about a precast, so prefabricated concrete elements. This is a huge growth segment in building materials. All the buildings you see, they're using more and more prefabricated concrete elements compared to doing the molding on the construction site. So we're going to analyze our existing business and try to find a way how we can multiply it. Then we have, related to this, we have concrete products. It's also exciting. In a few markets, we have concrete products. It could be pipes, can also be concrete tiles for flooring. Also here, we will first analyze what we have precisely and how we can multiply it. Then we have our asphalt business, very nice business, but only in a few geographies. So here we do the same. Try to find out, can we multiply it? Then we have contracting and services, quite a successful business, but also only in a few markets. Same for mortars or insulation. We also have smaller businesses there in very limited geographies, so also very exciting to start with. So we have already quite some segments, so we analyze this first before we would make a bold move to go into another segment.
Morning, Jan. Phil Roseberg from Bernstein. Just a couple of questions on your guidance and targets, please. If I've understood correctly, you have the 400 million of SG&A savings that you will implement over, well, certainly, hopefully in the next sort of 12 months or so. That already gets you to almost the guidance that you're giving of 5% growth in EBITDA. So what are the components of that sort of at least 5% in terms of savings and in terms of markets? That's the first question. The second question, again, linked to that, I noticed that your target's going out. It's quite brave to have growth targets, absolute growth targets for 2022 when the cycle could change. I mean, that's a big commitment. But you know, we'd like to understand what sort of element of scope you have in that. You've mentioned 2 billion of divestments that would come out of that number, but what sort of investments are you likely to make within that sort of envelope?
Maybe on the margin side, Phil, I didn't want to take away all the work from you. So we said, we said we make a minimum of 5% EBITDA growth. So it's up to your modeling what you think is realistic, but we commit to a minimum. I think in general, our new strategy is about execution and delivery. You know, I don't want to stand here and promise another set of amazing numbers. I want to, what I tell you today, will be delivered. So the 400 million will be delivered and down to the profit and loss, down to the bottom line. And I think that's key. And so 5% is the minimum. If you think we can do 6, you can do 6 in your model. The divestment and investment, that's a good question. I think we will start now to see more agility with our organic investments. So we closed 2017 with just below 1.4 billion investments. That's a kind of a record low. So we allow now the countries to have another 500 million for growth investments. That's quite a good number. So we feel comfortable with that framework. And then we will use some divestments to fund other growth opportunities like bolt-on acquisitions and so on.
So you're saying that roughly the sort of the M&A acquisitions versus divestments are going to sort of equal themselves out over that period?
That would be an interesting aspect of your model, but I think it's about right. It's about right. We want to fund the growth through the divestments. Yeah.
Thank you. Gregor Kuglitsch from UBS. A few questions. Can I come to the sort of the new segment, which kind of isn't new, as you said? Can you give us a sense, kind of as you see the business, say in 5 years' time, how important this will be? Will this become a substantial contributor in terms of the percentage of the pie? Because obviously right now it's relatively small. And then related to that, from a management perspective, I think you're going to a country management basis and less a product basis. But obviously there's traditionally always been the conflict that the managers, the country managers focus on their cement business because that's where the asset base is, and then they kind of neglected ready mix, and I think you kind of mentioned that, and perhaps the downstream. So I want to understand how you're going to incentivize that the downstream and the ready mix is properly run and actually generates the return that it should do.
Can I just answer first?
Please.
So yeah, that's a good observation. So obviously solutions and products, again, I'm very happy it's already 2.1 billion, so it's not a small business, and we want to grow this, of course, faster than the rest of the company with using these segments we have as a growth platform. So depending on possible acquisitions in that field, I cannot give you a number today, but the target is to make it a full leg of the company like aggregates or like ready-mix concrete. Then I'm glad you asked about the leadership. Is clear. Cement is and will be the biggest business segment for us also in the future. However, we want to have a dedicated leadership, so we're asking the countries to have separate general managers for cement, for aggregates, concrete, and for solutions and products to make accountability and ownership clear.
Thank you. Maybe one just on 2018, because you obviously commit to like-for-like EBITDA guidance of minimum 5%. Can you give us anything you want to flag from a technical perspective? I think there's a bit of M&A coming out. FX, just so that
Oh,
expectations are properly set?
The scope out effect for 2018 is really minor. It's about 15 million Swiss francs.
50?
Yeah, 15.
And then finally...
And then there will be acquisitions, there will be the plan rolling out, there will be some scoping, yeah.
And then perhaps finally, in the accounts, there's quite a lot of restructuring litigation costs. Can you elaborate a little bit more what's in there? Is that already covering the 400 million cost out? Have you provided for all of this? And if not, what is the cash cost to actually achieve these 400 million savings?
We don't give really detail on that, about the 400, Gregor. Actually, we have, you're right, we have provided for additional provisions in Q4. That's correct. For unexpected, actually, litigation cases and some restructuring costs as well.
That doesn't cover the 400, that's future.
That doesn't cover.
Okay, thank you very much.
Good morning. Jean-Christophe Lefebvre-Moulenc, CMCIC. I have, let's say, an amicable remark and two questions. The amicable remark is to be disappointed. Ich bin sehr enttäuscht. I don't find the traditional table with volume and prices disappeared. It's really a pity for us analysts. It's your own decision, but I fully regret. First question, in solution and product, it is, let's say, strategic U-turn, with, especially with formulated products, the motors. Will you grow only by external growth, or will you also use the existing capacities, notably with the laboratory of Lafarge in Lyon? And the second question is the difficult countries you mentioned, so Egypt, Iraq, Malaysia. Could we have more flavor in terms of volume, prices, and also costs in 2017 and maybe in the outlook in 2018? Thank you. Vielen Dank.
I'm glad you have interest in our volumes and pricing, but you find this information in the press release. We have still per region, we have volume, prices, everything is there. Only per region. Yeah, but that's good. That gives you a good indication. I'm honestly, we had this question before on the markets. You know, I think our building materials, we can talk about Egypt forever. Fascinating country, many possible outcomes. But I think to stay on the strategic level, for me, it's more important to look at our drivers going forward and the overall picture before we start talking about individual countries. This might be very interesting, but it doesn't help the overall picture. That's what you're also going to see from me in the future, I'm afraid. I will deliver my results. We can talk about everything, but I'm not a big fan of micro-market reporting. Yeah? For the solutions and products, I think we have an exciting opportunity. We have a few markets, a few countries where we have a very successful business in one or two of these segments. So we will try to copy and paste. So we have the opportunity to actually roll some of these products and platforms out. And then, as you say, we're also going to look for acquisitions. Yeah. Good.
It's John Fraser-Andrews from HSBC. My first question is around cost savings, and see that there was a big surplus last year in your price cost dynamic. Could you talk to what cost inflation was last year? It was at 9 months, it was running about 3.5%, and say what prices did against that. And then once we got that information, perhaps you can just say how much cost savings are going to be a feature of your growth moving forward. Obviously, the mergers synergies are done, but there were additional cost savings in previous years. Is that still an ongoing feature of the group? The second question is minorities and joint ventures. Are there any plans to tidy up any situations within the strategy and possibly go into new joint ventures as a possible tactic?
Jarlene, you take the question on inflation and...
Sure. We estimate our inflation without the energy at around 3 to 4%, and the energy inflation per se at around 12%. Yes, for sure, what you've seen, the price of the cost is over all this inflation, obviously, and it does include some cost savings for 2017. The 400 millions are obviously at constant inflation. Now, that, as Jan said, purely going down to the bottom line.
So the other parts of that, the costs going forward, and
I think because you will see us, we're going to run a much tighter ship in the future. We have already delayered the company with one layer. We commit to 400 million. You will see at the bottom line. So I don't know so much about the past, how happy you were with the cost initiatives, but we will deliver in the future. Maybe one remark on caution on the inflation, all this. I think it's very important to look at each individual market, pricing, demand, supply, inflation, special efficiency programs. It's a bit a box of different factors who then determine your margin. So just to look inflation or cost, that's too simplistic. That's why we also give this responsibility much more to the country in the future, because they are in the best position to decide what's best in that market.
And then JVs and minorities, what's the plan moving forward?
Well, I think we have a good set of JVs at the moment. We don't have any plans at this point in time to increase the number.
Thank you, Ephraim Ravi from Citigroup. Couple of questions. One on the free cash flow conversion to recurring EBITDA, 40%, that target. Can you give us the components of that? Because if you assume a 5% EBITDA growth, it almost assumes that there will be no increase in working capital in absolute terms to get to that free cash flow conversion. So what are the implied of working capital? And obviously, you've given the CapEx assumption. The second question on those new solutions and products business, you say it is going to be very low capital intensity with solid margins. Can you give us a sense as to what would be the ROCE of that business alone? I know you don't give ROCE by division, but because this is a new thing, it'll help us sort of model it out and get to your 8% ROCE target, in terms of it'll add credibility to the target if you give us the ROCE number on that.
We will come with a number, but later in the year. We are not in a position to share now a detailed plan for this. But it's much lower. You can benchmark with other companies in these segments, maybe if you want to model it or something. But to be on the safe side and on the delivering side, we come with this on a later stage.
On the cash flow conversion, maybe as Ram, yes, we plan to have actually less restructuring, litigation, and all these costs that will help, of course, the cash conversion, to continue our efforts on working capital, and actually to continue our efforts on the tax expense and also on the financing expense. So that's going to be the way to get to the 40%.
Thank you.
Remo Rosenau, Neue Helvetische Bank. Going back to the 40% cash conversion target again, that would lead to roughly 2.83 billion free cash flow in a few years if EBITDA goes up a little bit, as you have in mind. That means you have 1.2 to 1.4 billion additional free cash flow available. If it's true that you would fund your bolt-on acquisitions mainly via the divestments, you would not use that for acquisitions. So the other usage forms could be increase the returns to shareholders or reduce that further. So what should we expect, what you will actually do with this additional cash flow in a few years?
Oh, that's a great problem to have. And no, we will do everything to be exactly at that point. And then if we have no investment opportunity, we will return to the shareholder.
And what about the debt level? Are you happy to keep it where it is, or should it, still go down a bit more?
We want to, as Jan said, we want to keep our investment grade rating, and that's key to us. So that will be the constant measure to our level of debt, basically.
But you have not any target anymore, as in the past, with net debt to EBITDA multiple.
We don't guide that anymore, I'm afraid. Yeah, we're pragmatic.
Then a totally different question on North America. I mean, volumes are not growing that much anymore, but profitability has been increased nicely. Is the market back on import modus, i.e., local capacities are fully used, so they need to import again, you need to import again, which of course usually should help the pricing further?
I think for the US, we forecast great markets for the years to come. A good supply-demand balance. We have a bit of imports, but that doesn't really change the market structure. We are the market leader in the US. We are very bullish about the US. And with the US, we also have to consider that the infrastructure has not kicked in yet. So we have still 7 years of bottoming out in the infrastructure spending. Something has to happen. We have these 50 big projects, which were already in the election program of the current president, and at some point they have to fly. And so the market in the US, I see very positive for the years to come.
So solid outlook on volumes and pricing.
Yeah.
Thank you.
Okay, Bernd Pommerin von Tobel. 2 questions, if I may. First, a short-term question. Last year, you had a like-for-like revenue growth of 4.7% with a clear acceleration towards the end of the year. For the current year, you are now forecasting or targeting a net sales growth of 3 to 5%, which sounds a little bit more cautious than the growth which we achieved actually last year, while at the same time actually forecasts for global GDP growth are rather increasing. You also mentioned that last year cost inflation was 3 to 4%, and obviously in order to achieve a margin improvement, your top line should grow faster than your OPEX level. So wouldn't you be disappointed this year if you just achieved a net sales growth of 3, 4%?
Well, let's see how the years go, Bernd. You know, it's again, our strategy is about execution and delivery. It's not about promises. So I feel comfortable with the guidance, and maybe later you can, together with Phil, make your own model up to take 5%. But at the moment, I feel just comfortable. I want to execute, deliver. I'm not here today to promise you Wonderland.
Okay. Then one long-term question. This morning you communicated 4 targets for 2022. Yeah. 1 top-line target, 1 implied margin target, 1 free cash flow target, 1 capital efficiency target. And if I then look at your incentivation, you also are incentivized on EPS growth and relative share price performance, so 6 targets. If you have to prioritize these targets, or if you have to say which are the targets you focus first on, would it be fair to guess that you first focus on growth, because growth then should translate finally into margins and finally into improved cash flow generation? Is that fair to assume, or what is the priorities for these 6 targets?
I think first, Bernd, I'm very happy that we could simplify our system. So also in the future, I apologize already, but we will not guide on 30 KPIs anymore. We will guide on these top KPIs we focus on. This is part on making our management much more focused, much more simpler, and much more successful. If you look at the targets, I think in our model with a market growing at 2 to 3%, so that you can grow 3 to 5%, this gives you a great opportunity to do both growth and margin improvement, because you leave the cost a bit behind, a bit lower. And this is what we try to do. So at the moment, I have no priority. I want to really run all these targets at the same time. And if we can achieve the growth, 3 to 5%, the rest will fall in place. But I will never make a strategy not to make more money. This is, I think, one of the biggest mistakes you can do. Some people talk about, oh, let's go for market share or volumes or something. This I will never do. I want to make money from day one. So everything has to be profitable growth.
Okay, very clear. Thank you, Jan.
Martin Hüsler, Zürcher Kantonalbank. I also have two questions. One more strategic and maybe turning to page 24 or slide 24. I was just wondering whether you could give us still a bit an outlook, how this pie might look in 2022. You were mentioning that the solution and products should increase its size, but maybe also a bit if you look at the margins at the moment. And overall, we have 23% EBITDA margin 2017. Where could this margin go to into 2022? And which pieces increase their margins most?
Well, if you look at the four business segments, I don't give you the mathematical answer, but if you look at the four segments, you have to be very happy with the cement business. It's running at a high margin. Doesn't mean we cannot further improve it, but we will further grow the business like we have done in 17. You will see that going forward. Just invest into a new factory in India. So you will see this high margin business continuing to grow. On aggregates and concrete, we have a different situation. I'm totally unhappy with the margin we make. I think we have undermanaged that business, especially on a local market level. So we are now appointing local profit and loss leader, local owners of this business, because the margin is not acceptable if you benchmark with other companies. And also at the same time, the growth is also not acceptable. We are not growing in concrete, we're not growing in aggregates. This is the wrong direction. We have to come back, invest in new sites, do brownfield investments, have bolt-on acquisition. These are two very attractive segments, and many companies are very successful, and I want to bring us to that point. But this is growth and margin, and I think a big part will come from leadership and also from the willingness to invest. It's actually ready-mix concrete is not capital intense, but we have to have more plants, more mobile plants, and all of this. And then solutions and products is only on 2.1 billion level, so there's only one direction for this to go up. And here I'm very happy to give you more details later this year, once we have properly analyzed how we can make global platforms of these segments. So the pie is going to be very exciting going forward.
Okay, thank you. And then the other question is turning to cement and cement pricing overall. Could you maybe give us the price increase in the last quarter and actually the sequential price increase overall for the group? And maybe an outlook for 2018. In which countries did you increase prices already? And what do you expect a price increase in general for 2018?
I honestly, we will not guide on markets in the future. This makes no sense. We're going to have a great situation 2018. We have overall good markets. We will have selective price increases in some markets. Other markets, we have a pressure. We will not do it or not be able to do it. This is how we go forward. The whole pricing has to be handled by the country head and not by the CEO of the company. So we give that down, and we have the KPIs we talked about before are also the KPIs for the country head. So even I have no big discussion what he should do with the pricing, because he should know better than me. If he or she doesn't know better than me, we have a different problem. But the pricing or volume decisions in the markets have to be taken at the highest level of competence, and that's not me. That's the country head and his responsible manager for cement. But overall, I answer your question, overall, I think we're going to see a good margin situation for 2018.
Hello. Sorry, two follow-up from Ms. Arnaud Lehmann, Bank of America, Merrill Lynch. Firstly, on your ROIC target, I think you said above 8%. Could you please give us the starting point for 2017? And obviously, does it include the write-downs? I guess it does. And by the way, do you think 8% is good enough? You're slightly above your cost of capital. And so can you make more? That's my first question. My second question is on CapEx, referring to your predecessor, Mr. Olsen. His strategy was to say, well, there's already quite a lot of oversupply in many parts of the world. So we'd rather move cement around, build grinding stations rather than clinker capacity. You seem to go away from that a little bit and go back toward more clinker capacity. I appreciate you cannot, sometimes it's inland and grinding or trading is not always possible. But yeah, could you please elaborate a little bit about that? Because there are still a lot of places where oversupply is in place.
Yes, but I think it's a mistake to talk about clinker on a global level. You have to talk, clinker doesn't travel much. So you have to talk clinker capacity or demand-supply ratio on a local level. So for example, India, if I make a global rule now, we have enough clinker capacity. It's true maybe for the group, but in India we don't have. So in India we have to build a new cement factory to participate in the market growth, and we're going to have a great return on capital on that investment. So we have to look market by market. It's the same as the pricing. You will not see me talking much about this demand supply. You cannot talk about this on a global level. You have to go market by market, and this is what we're going to do in the future. For the return on invested capital, I give over to Geraldine. Just a comment, we don't say 8%, we say above 8%. And Phil will give you the exact number later in the break.
So, yes, so on 2017, our return on invested capital amounted to 5.8%. And about your point on the impact of impairments, it's really minor. It's less than 20 basis points, actually. Really what's going to drive it is going to be your future profitability or recurring EBITDA. That's all about it.
Johannes Bornes, Untitled. I will come back to pricing and not from the market side, but more on the efforts you did on improve the pricing due to value add you bring to your clients. Can you elaborate a little bit more on this? How much room you still see, maybe region per region there as well, obviously. How much room you see to improve the pricing just due to the fact that you were selling your products too cheaply in the past? That's the first question. Second question is coming back to capacity. I understand that is really regional. One has to have a look at it on a regional basis. But if I see the risk and chances or risk and opportunities you have, I was surprised to see you do some investments in India. But understood, because there you have really, you're probably close to full. So where is the chance to do more investments, or where are you tight in terms of capacity on the clinker side, production side, and where are you potentially you have too much still, or you have to grow faster, if I may say, without saying that you have to divest.
But you know, the capacity topic you cannot solve on a global level. You have to sell.
But region per region, maybe the bigger market.
Even in the region, even in the region, there's no point discussing it. You have to discuss country by country. What's your demand supply situation? What's the pricing? How many players you have? What are the competitors doing? And price increase is a target for every general manager in my company. It's clear. But we don't say we make a 5% price increase. It's possible in some markets. Maybe in some markets we can do more. And there are markets we have a heavy pressure and we are maybe happy to keep the price. So again, you know, you will see, I will commit to my financial targets. You will see all that end of the year, but the pricing topic is a difficult one. And we have cost inflation, everything, and the local person is much more competent to take that decision than me.
All right, thank you.
Good. Thank you so much. We have no more questions at this point. I think we invite you for some food and drinks, and then we have more opportunities maybe to discuss the one or other topic. Yeah. Thank you so much for joining today.
Thank you.